Tip number 3 is all about borrowing money. So it's all about debt versus equity. What we call that in the old accounting game is this funny little word called leverage. Now, leverage can be great because what leverage can do for you is it can provide a whole bunch of different opportunities. It can allow us to put a small amount of money into the business, borrow the balance, and really create something pretty awesome out of it. And Kiwis, let's face it, we love debt. We're obsessed with debt. We can't get enough debt. Okay? But this is a little bit different to the Auckland housing market. Here what we actually need to do is understand that business can go south and we will have little blips within the road. And so what we need to do is have enough strength and enough equity within our balance sheet and be appropriately leveraged so that we're maximising the use of our capital. So there's a couple of simple rules that we use on that one. Firstly, understand 1 or 2 absolutely key ratios. The first one I like to look at is the equity percentage. So it sounds difficult, but it's actually really simple. All it is working out how much money do I have in the business versus how much money does somebody else have in the business. And we compare that to our total number of assets. And the great thing about a balance sheet is it's always got a balance. So our total assets is going to equal the total amount of money that I've put in plus the total amount of money that someone else has put in. So once we understand those numbers, we can go take the total amount of money that I've put in, compare that to the total amount of assets, and that gives us an equity percentage. So what is a perfect equity percentage? To be honest, everyone is different. So it depends on your own personal risk profile, it depends on what assets you're funding, and it really depends on the actual size and quantum of the dollars as well. We'd like to think that anything under 30% of equity, therefore 70% of debt, you're starting to skate on some pretty thin ice. You really don't have much of a war chest if you're below that 30% mark in case something goes wrong. What's a perfect equity percentage? I would say certainly upwards of 40 and probably trying to get to a 50-50 mark. Then you've got a bit of safety and you've got the ability to use some of the other people's money. So really understand that piece on your balance sheet. Then once you've taken on some debt, it's really important to structure that debt properly, and again, this isn't too tricky. So we really have one quite simple rule around here, and that rule is match the life of the loan with the life of the asset. So that means really if your asset is going to last sort of a period of around 5 years, then don't try and pay it off in 1 year because you're going to get the benefit over that 5 years. So pay off the loan over 5 years. Conversely, it means if you're going to invest in an asset which is only going to last 1 year, so let's say a new computer system probably these days, don't fund that over 5 years because you'll be left with this dirty great bill and you'll have no asset left. So whilst it's common sense, in my experience, which is 25 years of advising businesses, I see this mistake made over and over and over again. And often that can actually lead to the worst outcome, i.e. some kind of liquidation or closing the door. So really, match the life of the loan with the life of the asset is my golden rule on borrowing. To put that another way, never ever suck short-term cash out of the business to fund a long-term asset, because you never know when you're going to need that money, and you never know when that mistake is going to come back and bite you really hard.